Welcome to the Deep Dive, the place where we don't just skim the headlines, we really get into the weeds, digging through the source material so you don't have to.
Exactly.
Today, we're tackling a really interesting one, Project Sonic, or S.
Yeah, Sonic. It's this ambitious new Layer-1 blockchain. They're calling it the direct successor to Fantom, technologically speaking. It's basically a ground-up rebuild.
Right, a complete overhaul. So our mission today is to cut through some of the hype. We want to unpack what actually makes Sonic different. Like, what are the big architectural changes compared to other fast L1s?
And crucially, we need to look at their developer incentives.
Yeah.
That fee monetization thing could be a game changer.
Definitely. So for you listening, we're going to translate all this complex tech stuff into, well, simple, actionable knowledge.
Let's do it.
Okay, let's start at the beginning then. The why. Fantom was known for being pretty fast already, right? So why did they need to basically tear it down and start over? What problems did Sonic have to solve?
That's a great question because Fantom was fast. But the sources we looked at, they make it pretty clear it hit this kind of invisible ceiling as it grew. It started to undermine its own goals, especially around decentralization.
How so?
Well, the biggest one was a classic problem. State bloat. The blockchain's entire history just got massive, too big.
Okay. And what does that mean practically?
It means that for someone new wanting to run a node, to actually participate in securing the network, syncing up with that huge history could take, well, the sources say weeks.
Weeks? Seriously, that sounds like a massive barrier.
It is. If it takes weeks and specialized hardware, fewer people can realistically run a node. That leads to fewer validators and, potentially makes the network less decentralized, less resilient.
Okay, so state bloat was problem number one. You mentioned Fantom hitting a wall. Was there another major bottleneck?
Yeah, the second big one was, interestingly, the standard Ethereum virtual machine itself, the EVM.
The EVM?
Yeah.
But isn't compatibility the whole point?
It is. But even with Fantom's fast consensus underneath, the standard way the EVM processes transactions became the bottleneck. It just couldn't keep up efficiently when things got really busy.
Okay, so the engine couldn't process the data fast enough, even if the network could deliver it quickly.
Exactly. The team realized, just tweaking things wasn't enough. They needed a fundamental redesign, a complete rebuild from the ground up.
So they had to tackle that classic blockchain trilemma: speed, security, decentralization, but in a totally new way. What's the big idea then? How would you explain Sonic's main goal simply? Like, what's the elevator pitch?
The simplest way to put it is they're aiming for Solana performance with Ethereum compatibility. That's the hook.
Okay.
They want to be the fastest EVM-compatible network out there. The claims are, well, they're big. They're talking about a theoretical peak of up to 400,000 transactions per second, TPS.
400,000. Okay, wow. That is huge. But is that like a real number or more of a perfect conditions marketing target? What do the sources say about actually achieving that?
It's definitely a theoretical maximum based on their new tech. Under ideal test conditions, we need to be clear about that. But maybe the real innovation isn't just the speed itself, but the business model that supports it.
The business model.
Yeah. Think of it like this. If the old Layer-1s were like these crowded cities with like old, slow plumbing, Sonic basically rebuilt the whole city's infrastructure. They put in a brand new engine and traffic control system for speed.
Right.
And they introduced this revolutionary business model for the app builders, the developers.
Okay, let's focus on that business model then, because you said it's unique. What is it?
It's called fee monetization,
Right.
or FEEM for short. And this is, I think, the potential game changer. Sonic offers developers, the people building the dApps, up to 90% of the transaction fees their specific app generates.
Wait, 90%?
90%.
That's radically
No.
different. On Ethereum, developers pay gas fees just like everyone else, right? So giving away 90% of the network's revenue, isn't that risky? Like, how does the core network stay funded and secure?
That's the crucial question. And it's about flipping the incentive model. See, on most L1s, developers are basically just customers consuming block space. Sonic turns them into partners. They're betting that by giving developers such a huge incentive, the sheer volume of transactions those developers bring will make the remaining 10% more than enough to keep the validators paid and the network running smoothly.
So it's a bet on volume over high individual fees.
Exactly. They want to incentivize developers not just to build, but to build things that attract tons of users and activity. It creates this really strong pull for developers to migrate existing EVM apps or build totally new stuff on Sonic.
Okay, that makes sense economically. The why and the what. So now, the how. How do they actually engineer this thing to handle that kind of speed and capacity? What are the key tech pieces?
Right, so there are basically three core technological pillars that work together. They're all designed to smash those bottlenecks we talked about earlier, the EVM limitations and the state bloat.
Okay, pillar one. Let's start with the execution engine. If the old EVM was the bottleneck, what's Sonic running?
They built their own custom virtual machine, the Sonic VM. It's designed specifically for high performance.
Oh, it's a faster.
It uses a couple of main techniques. One is just-in-time, or JIT, compilation. This translates the smart contract code into super efficient native machine code right when it's needed.
Okay.
And the second thing is something they call super instructions. These essentially bundle several standard EVM operations into one faster, combined instruction.
And the result.
Well, their internal tests, according to the sources, show the Sonic VM processes transactions about 6.5 times faster than a standard EVM implementation.
6.5 times. That's pretty significant. But, okay, a faster engine means you're just creating data faster, right? Which brings us back to that state bloat problem. How did they fix the storage issue?
Good point. That's pillar number 2. SonicDB, it's codenamed Carmen. This tackles state bloat head-on. It cleverly splits the blockchain data into 2 tiers. There's the live DB, which holds only the current active state data that validators need right now.
Okay, the recent stuff.
Exactly. And then there's the archive DB for all the historical data. By separating them, they managed to compress the required active data by nearly 90%.
90% reduction. Wow. And what does that mean for node syncing, that weeks-long problem?
It means that sync time drops dramatically, from potentially weeks down to less than 2 days.
Okay, that's huge. It makes running a node much more feasible, more accessible, addresses that decentralization concern directly.
Precisely. It hits the trilemma right there. So the third pillar is the consensus mechanism itself, how transactions get agreed upon and finalized. They call it speedy consensus.
What's powering that?
It uses an advanced proof-of-stake system based on something called the ABFTD protocol. Specifically, it's an evolution of the Lachesis protocol Fantom used.
Okay, ABFT, DAG, Lachesis. Let's break that down a bit. Why is that structure faster than a typical blockchain? What does parallel processing actually mean for a user's transaction?
Right. Think of a traditional blockchain, like a single-lane road. Every car, every transaction has to wait in line, one behind the other.
Sequential.
Yeah. A DAG, or directed acyclic graph structure, is more like a multi-lane highway with lots of on-ramps and interchanges happening at the same time. It can process transactions asynchronously or in parallel.
So multiple transactions confirmed at once?
Sort of.
Yeah.
It allows blocks or batches of transactions to be confirmed much faster because they don't all have to wait in that single line. This leads to really fast finality, the point where your transaction is confirmed and irreversible. We're talking sub-second finality here.
Less than a second. Okay, got it. Fast engines, smart storage, parallel processing. It sounds technically very impressive.
There's one more piece worth mentioning quickly. The Sonic Gateway. It's their native bridge back to Ethereum.
Oh yeah, bridges are important. What's special about this one?
2 things stand out. First, it's designed to be fast for withdrawals back to Ethereum around 1 hour, they claim. Compare that to the 7-day withdrawal periods you see with some Layer 2 optimistic rollups.
1 hour versus 7 days is a big difference. What's the second thing?
It has a built-in failsafe. If the Sonic network itself were to have a major prolonged failure, specifically if it halts for 14 days, the bridge is designed to automatically unlock and return user assets locked from Ethereum. It's a safety net.
Okay, that's a really important trust factor. So the tech sounds solid, designed to address specific problems. But tech alone doesn't guarantee success, right? Sonic needs users, developers, liquidity. Let's shift gears now. Who is actually using this thing, and why should our average listener care?
Good question. For the end user, the benefit is pretty straightforward. Potentially near-instant transactions that cost very little, maybe around 40.011 on average. Super cheap, super fast.
Okay, low fees, fast transactions. That's always appealing. What about developers? We talked about the fee monetization.
That's the big draw for them. Full EVM compatibility means it's relatively easy to bring existing projects over, and then you add that powerful revenue stream from Theme. It's a compelling package.
Are we seeing major projects actually make the move? Is there real activity and liquidity building up?
Yes. The ecosystem seems to be growing quite fast. The sources we reviewed confirm that some big DeFi names, you could call them blue chips, like AAVE, the lending platform, and Curve Finance, the stablecoin exchange, are already live on Sonic.
Oh, okay. Having a BVAM curve is significant. That brings immediate legitimacy and, more importantly, liquidity.
Absolutely. It signals to other projects that it's a serious platform.
What about backing from, say, venture capital or other institutions? That's often a key indicator for long-term potential.
The institutional support looks pretty strong, too. It's backed by well-regarded VCs like Galaxy Digital and Hashed. Getting their investment usually means the tech passed some serious scrutiny.
Any prominent figures involved?
Yes. Andre Cronje, who's a very well-known and sometimes controversial figure in DeFi, is the chief technology officer. His involvement alone brings a lot of eyes and credibility, especially from the crypto-native crowd.
Right. And any other major institutional signals?
I think the biggest one mentioned in the sources is the planned integration and listing with Coinbase.
Yeah.
That's huge, particularly for accessing U.S.-based institutional capital and wider retail adoption.
Definitely a major stamp of approval. So putting it all together, tech, incentives, big DeFi names, VC backing, Andre Cronje, Coinbase. Do we have any current metrics? Like what's the total value locked or TVL and user count looking like?
Yeah, as of when the sources were compiled around mid-2025, the TVL was pretty substantial, somewhere between, say, $550 million and $600 million.
Okay, that's real money.
And perhaps more importantly, the number of unique wallet addresses was getting close to 3 million. That suggests genuine user activity and maybe a successful migration from the old Fantom user base.
All right. It sounds like a lot is going right. But now we need that critical perspective. No project is perfect. What are the risks? What are the catches here? Because those big claims, 400K TPS, 90% revenue share, must come with some challenges.
For sure. And the sources do highlight several key risks and challenges Sonic faces. The first one is what you might call performance gap risk.
Meaning
the huge difference between that claimed theoretical peak of 400,000 TPS and the actual real-world average speed being observed.
Yeah.
Right now, that average is apparently hovering around just 3 to 7 TPS.
Whoa, 3 to 7. Compared to a potential 400,000, that's a massive gap.
It really is. And it creates this risk of, unrealized expectations. People might invest or build based on the headline number, but the current reality is far from it.
Why is the actual usage so low if the capacity is supposedly there? Is it just not needed yet, or is the network not really pushing its limits?
It could be a bit of both. Maybe the current applications just don't generate that kind of load yet, or perhaps they're still optimizing things. But the sources suggest the massive capacity is largely theoretical for now.
Okay, performance gap. What else?
Intense competitive pressure. This isn't happening in a vacuum. The Layer-1 space is incredibly crowded. Sonic has to fight tooth and nail for developers, users, and liquidity against established players like Solana, Avalanche.
And all the Ethereum Layer 2s like Base, Arbitrum, Optimism.
Exactly. Those networks already have huge user bases, massive amounts of locked value, and strong network effects. It's a tough market to break into, even with great tech.
Makes sense. What about the economics of the S token itself? Any risks there?
Yes, this is a big one. Tokenomics risk. Specifically, the native token, S, has no maximum supply.
No hard cap, so it's inflationary.
Inherently inflationary, yes. There are planned annual emissions, 1.5% of the supply each year for development and ecosystem growth, and then another 1.75% for staking rewards that kicks in after year 4.
So the total supply keeps going up every year. What does that mean for the token's value long term?
It means the network has to generate significant activity and demand to counteract that constant inflation. Ideally, the amount of S tokens burned through transaction fees needs to be equal to or greater than the amount being newly emitted.
So value depends entirely on network usage offsetting that built-in inflation. That sounds like a constant uphill battle.
It is. It requires sustained, high-volume growth.
Yeah.
And that risk is potentially amplified by the way they launched the token.
How so? The airdrop.
Exactly. They did a massive airdrop, 190.5 million S tokens, to bootstrap the network and reward old Fantom users, which is great for initial distribution, but it creates this significant potential selling pressure hanging over the market. Even with vesting schedules designed to discourage immediate dumping, that's a lot of supply that could hit the market eventually, potentially dampening the price.
Okay, so performance gap, competition, inflationary tokenomics, airdrop overhang. Any other major concerns? Maybe back to decentralization.
Yeah, that's the last main point the sources raised. Despite the tech like SonicDB making nodes easier to run, the actual number of validators securing the network at launch or shortly after was relatively low. Some sources mention figures like 41 validators.
41. Compared to, say, Ethereum or other large networks, that does sound quite centralized, especially early on.
It was definitely a concern. As the network aims to secure potentially billions in value, increasing that validator count to improve decentralization and resilience will be really important for long-term trust.
Okay, that gives us a pretty balanced picture, I think. The impressive tech and incentives on one side, but some significant risks and challenges on the other. Let's try to wrap this deep dive up. How would you summarize Project Sonic in just a sentence or two?
Okay, Sonic is basically a super ambitious, high-tech reboot of Fantom. It's aiming to be the go-to super fast platform for Ethereum developers, using this really unique profit-sharing model to attract them.
And its success.
Its success really boils down to whether this cutting-edge tech and novel economics can actually win out against the fierce competition and overcome its own tricky inflationary tokenomics.
Right. That leaves us with a final thought for you, the listener, to chew on. We talked a lot about fee monetization, giving developers up to 90% of the revenue.
Yeah, the provocative question is, does that model fundamentally change the game? Could that economic incentive alone be powerful enough to let Sonic capture a huge chunk of the EVM market, even with all the competition?
Something to think about. What does it mean when developers become primary economic partners of the network? That's definitely food for thought as we wrap up this deep dive.
Absolutely. And if you enjoy these kinds of breakdowns, well,
You know, this is a great point to quickly pause and remind our listeners of something.
that's right. If you're enjoying how we break down these complex projects into simple pieces and want more reviews just like this, make sure you subscribe to our channel, CryptoBox. We do all the complex research, so you don't have to.